Okay, so our numbers have sort of tapered off for people joining. So I think we'll get going here. Again, thank you so much for taking the time to learn a little bit about saving tax by using life insurance. Today's presenter is an expert, absolute expert in the field. His name is Sterling Rempel, and we work with him at Aiken Henderson, and we're fellow members of the Trust and Estate Practitioners Group in Calgary here. Anyways, without further ado, I'm going to hand it over to Sterling. And thank you so much, Sterling, for giving out some great information today.
Great, and thank you for inviting me to talk about life insurance, which is a fascinating topic to me, less so for other people, and I recognize that, but there are some important tax aspects that I want to go through with you. So I'll set some context, I'll talk about the tax situation, and then I'll talk about some strategies that business owners can consider. And when I say business owners, I'm talking about entrepreneurs, owner-managers, professionals who have built a practice, their business around their practice, including dentists, doctors, ophthalmologists, veterinarians. We deal with a number of different professionals in that, as well as entrepreneurs. So when I'm dealing with small business owners, really there's 5 major concerns that they express to me. They want to make smart decisions about their money. They want to mitigate their taxes. They want to take care of their heirs. They want to protect what they've built up from unjust seizure, whether that's litigation or potentially divorce. And many of them are charitably minded and want to be involved in charitable giving. And so really there's 7 planning areas that we deal with at Future Values Wealth Management. And it's a little formula, WM equals IC plus AP plus RM, and that's investment consulting plus advanced planning plus relationship management. That advanced planning is wealth enhancement and mitigating taxes, wealth protection, both of your income as well as from creditors or seizure, wealth transfer, going ahead and moving that wealth down to subsequent generations, and also to magnify the impact of their wealth and the business success that they've had through philanthropy. The relationship management part of it is both our relationship with the clients as well as our relationship with their other professional advisors like you, Clayton, as a CPA. Well, I want to set the stage here that Canadian business owners are Canadian superheroes. Together, you, Clayton, and our guests, and myself as a small business owner comprise 98% of the Alberta economy, slightly less of the Canadian economy. Small businesses under 100 employees comprise the substantial portion of the economy. Almost 70% of all jobs are in businesses under 100 employees. More than half of that, 70%, have less than 5 employees. 3/4 have less than 10 employees, and together we contribute about 42% of the GDP. So GDP plus job creation leads to income tax, which funds the federal government. So you'd think they'd be on our side, right?
I was just gonna say, we are superheroes. Thank you.
They have been, and private corporations have had tax advantages. The Department of Finance, Canada Revenue Agency, have given us opportunities, including a lower tax rate on the first $500,000 of income, and tax deferral on the money that we've kept inside our companies, the opportunity to income split through dividends with spouses and adult children. It used to be little children, but that was taken away. The opportunity to get to sell the value of our business and receive a substantial portion on a capital gains taxation-free basis through the lifetime capital gains exemption. There's opportunity for income planning between salary, which is eligible for a Canada Pension Plan, and our RSP, as well as your own group insurance benefits, as well as dividends to obtain lower tax rates. By having different year ends, we can shift the tax year that our income is taxed in. And of course, corporations provide limited liability and potential creditor protection. So good things all until July of 2017 and subsequently the budget in 2018, which was entitled A Fair Tax System for All Canadians, which amounted to a small business tax attack. where income splitting was eliminated. There was an attack on the tax deferral of the corporate investments, the money that we've built up for our retirement or for our children's education or for emergencies or for cash flow or to pay our employees and make payroll. And also a limited access to the small business deduction. And so more of our income might be subject to a higher tax rate. And so those lead to 4 tax traps that we see. Certainly the tax on split income. Clayton, you've written a lot about this. You were very vocal during that period of time, and I thank you for that. And so we've been prevented now from dividend sprinkling to spouses and adult children if they're not actively working in the business. We're still discouraged from leaving money in our corporation because any growth on that money, if it's not used for active business purposes, is going to be taxed at a high rate, 48.7%. Well, that's on interest. Capital gains and dividends from Canadian corporations are taxed a little bit more favorably. However, you're allowed to earn $50,000 of passive income on your investments. Beyond that, every dollar that you earn beyond that $50,000, you lose $5 of the small business deduction. And if you do the math, that means that if you have more than $150,000 of passive income, maybe you've sold shares and realized a capital gain or sold other real estate that you held in your corporation, your small business deduction is gone and you're taxed at the top corporate rates. So more passive income leads to higher corporate tax rates on our business income. And of course, we can always lose the opportunity to use the lifetime capital gains exemption because when I pass away, I'm deemed to have disposed of the shares of my company, and we could get capital gains on the first $883,000, but only if I've got 90% of my assets in my business actively used in that business. So if I've got a whole bunch of investments inside my corporation, that could put me offside, lead my shares to high taxation for my estate.
Sterling, can I jump in here for 1 second? One thing I forgot to mention at the start of the webinar, there's a Q&A top right. There's a little question box. I see some people are interacting. There's already some fun comments in there. Thank you so much. But if you have any questions for Sterling, we are 20 seconds ahead of you. So pop them in there and I will get them to Sterling at the end of the presentation. Thank you, and I'll shut up now.
Okay, and I'm not reading those chats, so heckling, I guess, isn't going to be any not effective right now. So let's talk about life insurance and the superheroes that can create. So how can it be used for tax planning? Well, in order to understand that, you first have to understand a little bit about the basics of life insurance. And so here you go. It's probably not surprising to hear that the cost of life insurance increases the older you get. You know, intuitively, it's cheap when we're young, it's expensive as we get old. This is a graph for somebody starting at age 40. The year along the bottom line is the subsequent years from age 40. So it starts low, goes up. And when people buy term insurance, really what they're doing is they're leveling out a portion of that curve. That's an example of 10-year term. 20-year term is the same story. But when you add up all those numbers, and if you keep it out to life expectancy, which is about 83 for males and 87 for females, really all of your premiums have funded your life insurance. The total cost of insurance eventually equals the amount of death benefit. So why do I need life insurance? If I'm going to live forever, well, you don't. But tell me when you're going to die, and I can tell you what kind of life insurance you can get. So this is the total premiums of the annual increasing costs. Can you see my cursor if I move it around?
Yeah, yes, I can.
Okay. So same deal on the 10-year term insurance. The cost of 10-year term approaches the same amount. And the 20-year term, again, if you've got 500,000 of insurance, you've paid 500,000 of premiums. So this is where people want to levelize the cost of insurance so that they pay higher premiums now to pre-fund those higher costs later. And in doing so, that creates what's known as permanent insurance for the whole of your life, hence the term whole life. And if you do that, the total cost of that level premium does not approach the $500,000. And that's because we've been building up a reserve, which I'll get to in a second. So you can pay a level premium for life. You can, just like a mortgage, you can pay more and shorten it up. You can pay it up over 20 years. You can pay it up over 15 years. You can pay it up over 10 years. And there's opportunity to add in excess deposits and pay it up quickly in 10 years, plus jam in as much money as you can into that insurance policy and let it grow on a tax-sheltered basis. It's that policy reserve and the investment growth on the deposits that you've made that funds the future costs of the insurance, and it grows on a tax-sheltered basis, because life insurance's ace in the hole is the unique tax treatment that it offers. There's that tax advantage growth of the policy reserve, the extra money that you've put in. That's called the cash surrender value. And that tax-free investment income, as it's earned annually, well, it's tax-free. And that tax-free interest compounds, and we have tax-free compounded growth. And you can access that money. It's your money that you can access for emergency cash flow or business opportunities or for retirement. Of course, certain restrictions apply in terms of how much you can take out. Life insurance's second benefit or tax uniqueness is the tax-free death benefit to the beneficiaries, and that's for personally owned. And if it's corporately owned, that same tax-free benefit comes in, and that can go out to the shareholders tax-free through the capital dividend account. That policy reserve, that cash surrender value, that's an asset of you, the policy owner, whether you own it personally or through your business. And those reserves can increase that tax-free benefit amount. So as I said, those reserves are accessible by the owner. All or a portion can be withdrawn as cash. It can be borrowed against, without any questions. You don't have to go sit in front of a bank officer and tell them why you don't need the money so that they will lend you the money. They will lend it to you without question. And you can also use it as collateral for a third-party loan. Banks do love this stuff because it's secure collateral. And if you do a loan, the interest paid, that may be deductible if that loan was used for business purposes. You should talk to Clayton or your own tax accountant in your own situation. So again, permanent insurance is made up of two types, what's known as whole life, the participating, where you share along with the company in their profits. That has guaranteed values, and those values are vested. Once they're credited to you, they're yours. They don't go down. It has professional management of that reserve, kind of like a pension committee. They have a special deal with the accounting rules on that. If the stock market is up high or down low, they don't have to mark to market every year. They can smooth in gains and losses over a 5-year period. And in doing so, that really does smooth out the investment returns inside of that portion. So you have low volatility, you've got low management fees, particularly as compared to mutual funds or other investments. And as I said, it's preferred collateral. The other type of permanent insurance, universal life, gives you a lot more flexibility. You're involved with this. You can choose to put in extra money, you can stop payments, you can choose how that reserve is invested. It's generally lower cost to start because it hasn't got that investment component built in, and there are some guaranteed values. So here's an example of how it could work. For the price of a minimum wage employee, again, a business owner, a male, age 40, non-smoker, minimum wage for an employee would be $15 an hour, 40 hours, 52 weeks, that's $31,000 a year. That's a hefty premium by any measure. But if you pay $31,000 into one of those maximum funded 10 payment policies, here's kind of how it looks. The red is the sum of the premiums that you've paid. This orange is the guaranteed values. So you can see that you're not quite getting back all of the money that you put in, but the guaranteed values plus the projected investment returns does exceed the amount. So you can buy this insurance, and if you decide to cancel at some point, you can get all or some or most or even more than the money that you put in. And the life insurance, this $31,000 here transforms into $500,000. This purple line, these purple bars, are what the guaranteed amount is. And the guaranteed amount plus the investment reserve growth leads to an increase in death benefit. So you layer these two on top of each other, and you can see that for the price of a minimum wage employee, you can supply your business and ultimately your heirs with a substantial amount of money and have access to that in the future. And it's that that gives us some tax opportunities. Anything here before I move on?
I'm not seeing any questions yet, so we'll just keep rolling along.
So does it make sense for you? Well, I don't know, is the short answer. I like this chart from Leon Danko in a book called Beyond Survival about family business. He said businesses go through 4 stages: the wonder, the blunder, the thunder, and the plunder. We wonder if our business is going to survive. We blunder through the mistakes. We thrive, and that's the thunder part. And ultimately, either we divest of it, we sell it, we wind it down, or we go on to a new growth curve. And really, depending on where you're at in the business, there are different things that might be appropriate. For startup businesses, there's a focus on cash flow and protecting debt, protecting yourself against the loss of a key person, funding by sales, and to protect your own insurability. And those elements that businesses need to consider grow as your business grows. So I want to talk briefly about 9 tax advantage planning strategies for each of those segments. 3 for the startup, 3 for the growth, and 3 for the established phase. I hope you notice that I'm continuing the superhero theme. So startup phase, you are the business. It really depends on you, and your family is relying on that. You are the financial breadwinner for that, and so we recommend that you protect your economic value for your family and get a bunch of insurance, low-cost term insurance. So if you die, it replaces your income for your family and replaces your invested capital. And it also locks in your future insurability. If you do it while you're young and healthy, then when you're older and your health is more checkered, your medical conditions have come up and maybe prevented you from buying insurance, you've got it. So the tax approach is, if you need it and you have a corporation, you can either move an insurance policy into your corporation or buy a new one and pay for it with corporate dollars, those dollars that were taxed at the low small business rate. And if you die, the majority of that tax-free death benefit is paid into the corporation, and then paid out through the capital dividend account. I say the majority of it because there's a tax drag. It's the amount of insurance minus the adjusted cost basis. And basically, that's the amount of insurance minus however much excess your corporation has put in for the investment component. If it's all just pure cost of insurance, term insurance, then there's not a high adjusted cost basis. And you'll see that the word is basis, not base. In most accounting, it's adjusted cost base. Life insurance has a special term. It's adjusted cost basis of a policy.
Sterling, I just want to pause and wrap here for a second, because this is really a key point, is that third bullet point, which is, this stuff costs money, right? And if you're going to have a life insurance plan and you own a private company, you may as well be paying for that in some form or another with corporate dollars. That is the layer of wealth that exists between the cash register ringing and your personal bank account filling up. There's a lot of in there, and there's a couple layers of tax in there. And what Sterling is saying is you get to pay for that at the corporate level, not at the personal level. And if you had to pay with it at the personal level, it would take a lot more dollars to pay for that same policy, because you've got to pay more tax to get at those dollars. So that is a really big point, planning point for a lot of our clients is, let's talk about getting your life insurance policies into a corporation where you're paying with corporate dollars.
Thanks very much for that endorsement. And that's the way my own plan is structured. I've got an operating company, I've got a holding company, I've got a family trust, and I've moved my insurance policies into my holding company, frankly, and I'll talk about that perhaps a little bit later. And I move money from my corporation through intercorporate dividends up to my holding company, and my holding company owns a bunch of my life insurance. And so when I pass away, that holding company gets the life insurance proceeds. And who gets my holding company? Well, it's my family. And so my family will ultimately receive this holding company share, and the majority of the insurance can come out to them tax-free. So I've had my business pay for something that ultimately has benefited my family. Moving on. Second part of a startup phase, your company has debt. Maybe you've bought a building, maybe you have inventory loan or line of credits or lease obligations. You can buy insurance through the bank. You can also buy it through somebody like me, an independent. But if your lender requires life insurance as collateral before they'll give you the loan, it doesn't matter if you buy it from them or from me, the premiums paid can be tax deductible as a business expense. Again, up to the net cost of pure insurance, up to the amount of that red line, wherever you are along that first red line. Again, if you die, the lender gets repaid, but there's still a credit to your capital dividend account, and that allows your accountant to pay out future profits tax-free to the surviving shareholders. So not only does your lender get paid out, but then the rest of the company value can in fact be stripped, or a portion of it can be stripped out tax-free to the shareholders. And just by the way, if you have a bunch of debt, and if you think your business might go bankrupt, I am sorry. But if you did have money in RRSPs, that's protected in the event of bankruptcy, but not if it's fallen short of bankruptcy where your creditors have reached an agreement with you. They can still get your RRSPs at the bank. If you hold that money inside an insurance company with segregated funds, then that may offer creditor protection and give you some start over money in the event of that business failure. The third part of the startup phase, your company has key employees. Your business is relying on those people. There's an economic value to your company. If you buy insurance on that person, the premiums are generally not tax deductible, but you still get the insurance amount tax-free, and that buys you time to readjust, to have liquidity and cash flow for your business, to replace lost profits or downtime. It helps to reassure your creditors that this person, this general manager upon whom you've staked so much, can be replaced. And that can help fund employee search and hiring costs. Moving on to the growth phase, you've got partners, you've got shareholders. Well, first thing, talk to your lawyer, talk to your CPA, draft and sign a unanimous shareholders agreement. I'm told that many of them have been drafted, but a lower percentage has actually been signed. Those unanimous
talking about it over beers in the pub does not constitute drafting it. So we see that all the time. Oh yeah, we talked about all that stuff. Great. We're going to need that in paper, all the time. And even between, I mean, it's relevant for so many reasons.
Right. If I'm in partnership with my brother, for instance, and one of us passes away, well, then the surviving shareholder has to deal with the in-law, with my now late brother's spouse. So how are we going to do that? And does that person want to be involved? Well, that unanimous shareholder agreement can deal with disputes, it can deal with death or the disability of one of our partners. If we get divorced, well, our business is community property, marital property, and could be subject to division. And so instead of 2 shareholders, we might now have 3 shareholders. It can also deal with departure, retirement, termination, or bankruptcy of a shareholder. So we recommend that you fund the buy-sell component of it with life insurance, disability insurance, and with critical illness insurance, which frankly you're more likely to collect on before you're age 65. Critical illness insurance pays a lump sum if you have a heart attack or a stroke or a cancer, stuff that we used to die from, but now medical advances have left us surviving that, but it still has a great impact on one's business. Again, tax-free payouts, premiums aren't tax deductible. If you did one of those permanent policies, you can build up a tax-exempt sinking fund for your future buyout. Okay, so you're growing, you now have surplus cash. I pointed out that those surplus cash dollars are going to be taxed at a high rate inside your corporation. You can move them up to a holding company to remove them from the operating company's creditors, but even inside a holding company, they're still going to be taxed at investment income tax rates. So you can transfer a portion of that into permanent life insurance, and maybe think about a portion of your fixed income investments, because these policy reserves are sort of like a fixed income investment. Again, pay the premiums with lower tax dollars. You get the tax-exempt growth and compounding, you minimize the investment income tax, and of course you minimize the passive income that can cause the small business deduction grind. That policy reserve, as I said, was managed professionally. You get asset diversification. It's like another asset class in addition to equities and fixed income. It offers improved yields over current fixed income yields, which are 2/3 of nothing right now. It does have guaranteed minimum values. Once the growth is credited to you, it's vested, it doesn't go down, it only goes up, low volatility and low fees. So growth phase, I like this picture of the Hulk. Your business has grown significantly, and now you're beyond the lifetime capital gains exemption amount. Or maybe you've had a medical or dental professional corporation that you've retired from, and now it's turned into an investment company, and you don't qualify for whatever reason for the lifetime capital gains exemption. So there's going to be a taxable gain on the increase in value of your company shares upon your passing, and your estate is going to need to deal with that. So you can fund that with permanent life insurance. I had dealt with two individuals who built up a midstream company, sold it, locked in their share values, locked in the capital gains exemption, and they had a deferred tax liability. And it was about $4 million. So one of them bought a policy for $4 million. In fact, it wasn't on his life, it was on the second to die of his life and his spouse's life. And instead of insuring me or my wife, if we insure them both together and pay out when the second one dies, that's a longer time period. And so it's like insuring a younger person, and the cost is down. So anyway, that guy bought $4 million worth of life insurance, and that's going to pay the tax when he and his wife dies, which is when the tax bill is going to come. The other guy said no, he was charitably minded, and he bought $8 million of permanent life insurance, and he has a foundation with his name on it that's going to receive the proceeds of this $8 million. That gives his estate a charitable tax credit of about 50%. So charity gets $8 million, and Revenue Canada Revenue Agency, gets zero, which I think is a beautiful thing. If your company's grown in value, you can also donate your private company shares to a foundation like the Calgary Foundation. They will gladly receive your private company shares, which your estate will then buy back from the corporation or from the charity with the funding of insurance. Why would you donate the shares? Why wouldn't you just give them the money? Because if you donate the shares, then there is no capital gains taxation under current tax law. There's two other strategies to reduce the value of the corporation. In the interest of time, I won't spend very much time, but you can also look at something called a corporate insured annuity, which takes money out of the corporation, buys an income stream, which funds a life insurance, which replaces the money. Long story, but that does remove the value from your corporation. And similarly, if you set up an individual pension plan for yourself and your family, that can also help to reduce the value of your corporation at the time of the tax incidence. We're into the established phase. You've got kids in the business. You want to have one child take over the business. Frankly, if I had
Sorry,
one...
Shirley, for a sec, because I really found it interesting. It's, you know, we're talking about removing value from the corp. And just to tie that back into your earlier comment, that the reason that we want to do that is you've built up excess in the company, you may be investing it otherwise, but the point is you need it off balance sheet, perhaps, in order to qualify for the capital gains exemption, which is a huge tax win, right? So, you know, I think when we talk about removing value, it's with an eye to that, right?
That's right.
Yeah.
And that's where your expertise is critical. Do not try this at home yourself.
Thanks. Thank you. Okay, sorry to interrupt.
So once you're established, you may have children in the business. I was going to say, wouldn't it be great if I had one child interested in joining my business? But thus far, their response is, not a chance, Dad, but thanks. So suppose you do have a child that's interested in the business. I've dealt with one construction company that came to mind, a father and a son. There were other siblings. The father and the son built up the business. And they had a buy-sell arrangement, which I'll get to in a second. If you don't have your child in the business and your company's grown in value already, you can freeze that value and kind of put a line on top of how much more it's going to grow and take that value off and put it into preferred shares. And then your child can buy into the company at a nominal value. I put $1 here, but they can buy into the common shares at a new starting point. And then any future growth ends up in that child's hands, or perhaps you want to participate alongside with that. But the bulk of the value has been moved over with preferred shares. Well, those preferred shares are just sitting there. Eventually, your child, if he keeps your business going, he or she keeps your business going, can pay you dividends on that, and that's a tax-preferred retirement income. Your company can buy back those shares over time, and that too is a preferred retirement income. And if you pass away and your spouse passes away, well, your corporation can then use, again, life insurance to buy back the value of those shares. And that value of those shares is what the other kids were going to get. So that money goes up to the estate and then can be distributed to the other partners, so that the one child doesn't have his siblings knocking at his or her door looking for money. And I mentioned the construction company. That's exactly what happened. The father passed away. The money from the buy-sell went to Dad's widow, and that's sitting there for the other children, and the child in the business is going to get the business. So you've established, but you want to keep going. Just like Peter Parker, you want to swing from one building to the next building. And you see the need for life insurance after all of this, but you don't want to pay for it. Well, welcome to the club. Nobody does. So you can use leverage. And this is a significant and growing area of insurance planning. You purchase permanent life insurance. You put in a lot of money. Up to the maximum that you can put in. It's got high cash values at the end of the first year, and it's secure collateral. And so banks will lend you money against that. So you put it in, maybe you're out 8, 9 months, 12 months on that money, but you borrow it back. So if you put in X amount of dollars, you borrow back X amount of dollars secured with the deposit. And so you've got those cash values securing the loan, borrowing the premium back. The funds are now back replenished in the business. You use those in the business, and so that's a business loan, and so there's a potential tax deductible interest on your loan. And so you've got insurance, and you haven't paid very much, if anything, for it. And lastly, you've achieved success. Now you want to have significance from your wealth. You want to give back. Well, if you bought life insurance in the past and you want to continue it on, but it's becoming pricey. Well, let's say you have an existing term insurance policy that's going to go up in price. If it's personally owned, you can bring it back into the company, or if it's corporately owned, you can donate the policy ownership to a charity or the fair market value. If it's term insurance, it doesn't have fair market value unless maybe your health's changed, maybe you've had cancer or a heart attack and you can't get insurance anymore. You couldn't pass the medical. So that policy does have a value, and actuaries are standing by to provide a valuation on that. And when you donate that policy, you get a tax receipt from the charity, and that can help reduce taxes. If it's term, once it's inside the charity, you can convert it to a permanent policy. And the charity now owns this permanent insurance policy. What are they going to do with it? Well, they're going to wait until you die. Who's going to pay for it? You are. Your corporation is. And each premium payment is then a tax-deductible charitable contribution. So 9 strategies, ultra quickly, with these cautions. One size does not fit all. Get professional advice. Hold the permanent insurance in a company you don't want to sell. Like in my case, in the holding company, not the operating company, because if somebody comes along with a big check and buys out your operating company, you don't want that company to buy your insurance policy along with it. And it's pretty hard to move it out of that company. It's possible, but there are some issues. If you do transfer the ownership of a policy, make sure that you're aware that it does need a fair market valuation. US citizens, all bets are off. There are special tax situations. And if you bought corporately owned life insurance before 2017, good for you. The rules changed, and that stuff's even more valuable. Don't make a change before you check into it. And then finally, this is a sales pitch. Sorry, why consider applying for insurance now? Well, in our COVID environment, there's certainly a heightened risk awareness, and you can protect your future insurability. Even if you don't die, you might get sick. But it's kind of contrary thinking, but insurance companies have made it easier to buy right now. They've relaxed their underwriting. They've reduced the situations where a nurse needs to come out and draw blood and urine. You could get more with less of that kind of stuff. There's online virtual applications that we are using now. And in fact, there's some special premium offers out there with 4 months of free premiums on term insurance. And with that, I'm going to stop sharing my screen and back to you.
Sorry, I guess I'm on mute. I said fabulous. Thank you, Sterling. That was great. So we do have a couple questions in queue, but I also recognize that we have a 20-second delay. We still got a ton of people on, and I mean that's a lot of information you gave us. So we'll just give everybody, start typing now, and we'll get your questions in here. And so we got a few. So back when you were looking at the red, purple, and blue lines, Sterling, Alex asked a question. So what I gather from this chart is your IRR on the first year is negative until it becomes positive and self-funding. So what could be an expected total return over a 30-year whole life policy plan, Alex?
That is a great question. The answer is it depends. In most cases, as you approach life expectancy, or even after 30 or 40 years, the internal rate of return inside the policy is in the 3 to 3.5% range using insurance companies' current dividend scale, basically what they're getting right now on their policy reserves. So that's 3.5% inside a tax sheltered vehicle. In order to achieve the same result without that tax sheltered wrapper, you'd need to be looking at 6 or ultimately 7% internal rate of return in order to match the deal. And so because the values are guaranteed and only go up inside of a policy reserve, it's like buying a GIC. So you'd have to find a 6 or 7% yielding GIC for 30 years. And if you find one, please let me know, because I'd like to load up.
So that's a great question. Are we? You can't hear me?
Now I can.
Sorry about that. So I said, that's a great question. We can expect in some policies a guaranteed rate of return, and not be subject to certain market fluctuations? Like, how does that work?
Yeah, if you think back to one of those first charts, there was the orange guaranteed values and the green, the guaranteed values plus the projected investment returns. Well, those projected investment returns are projected. You don't know what they're going to be next year. The insurance companies are motivated to keep them relatively stable. And so the future dividends are not guaranteed, but once they give it to you, it's vested, it's yours. It does not go down in value. And so it's a ratchet that only moves forward. It doesn't go back.
Yeah, cool. Okay, another thing, I just noticed that we both have incredibly interesting rooms that we work from home in. So I'm glad to see. We're usually looking at books or something, but well done on your backdrop.
Well,
okay, this one is from.
No, this is my office, and I'm working in my office. My staff member is here, but we are remote. And the design on this is my wonderful interior designer wife, Tracy Warden of dovecottdesign.ca. Thank you for the plug.
Yeah, awesome. Okay, so this one is from Anonymous. So Anonymous, thank you for posting the question. If you pay corporate dollars, the death benefit is also going into your holding co. Would that not mean that the heirs need to pay tax to access that money personally? I'll take the first part of the answer, and that is that there's a mechanism within our tax system which allows a certain component of the tax of the life insurance payment that enters the company upon death to it increases what's called a capital dividend account. And so there's a mechanism to get a certain portion of life insurance proceeds out anyways, tax free. But it's a yes and no question. I'll let Sterling answer the rest of that.
And my answer is what Clayton said. The majority of the tax-free death benefit into the corporation can come out, again, the majority of it can come out tax-free. That is a longer explanation required, and I'd love to have it. I need a piece of paper in front of me in order to explain it.
Yeah, fair enough. Okay, so Anonymous, maybe another Anonymous, maybe the same one. If I want to put the policy into corp, does it need to be in the corp's name?
Well, the payor and the owner should be the same, because if I've got a corporation paying for something that's owned by somebody else, let's say they're paying for a policy that's owned by me personally, all of a sudden that's a shareholder benefit, and that's a taxable situation, and I want to avoid that. So the entity that's paying for the policy should also own that policy, and by rights also be the beneficiary of that policy.
Now, that's a bit of a recent development, though, isn't it? Or there's been some changes around that where you could have separation between the payment and the ownership of the policy between different corps anyways. And some people might have a legacy policy set up. But do you want to talk about that for half a second?
So some people would be having the policy inside the holding company, but the operating company is actually paying the premiums for it. That is generally not accepted to be good practice at this point, given the CRA roundtables with the life insurance industry.
Thank you. And thank you for keeping it concise, because I know that could be a whole 1 hour webinar. Okay, so to do a comment, not a question. Good note on U.S. citizen owning life insurance. Thank you, Anonymous. Roxanne says lots of great information in here. Thank you. Thank you, Roxanne. And Alex says thank you. So I'm assuming that Alex is saying thank you. We've answered his initial couple of questions to a satisfactory level. I don't have any other questions, but I'm welcome to I'd welcome hanging out here for another minute or two. Sterling, what I would like you to do, if you could, is share your screen with that opening slide of your info so that everybody knows where to get a hold of you if they want to have an assessment done of their existing plan, or take a look at what might be some good planning options for a future plan.
Sure. That's a picture of our office. We're on 15th Avenue, within crawling distance of the Ship and Anchor.
Sorry, no,
And-
I mean, that's amazing, but I'm having trouble sharing it. Sorry, give me a sec here. Okay. Oh, there we go. Perfect. There we go.
Oh,
We're
good. So we're on 15th Avenue between 5th and 6th Street. The greatest thing about our location is that we have 2-hour free parking out front, that close to the 17th Avenue and the Beltline. It's a beautiful thing. So we'd be pleased to talk with you.
All right. Well, thank you so much. This has been a great, very informative webinar, and I appreciate that you brought some superheroes into it, because I agree with you. Entrepreneurs truly are superheroes and wealth creators and job creators, and life insurance planning is sort of one of the last strongholds for private company tax planning that exists. And you know, I can't thank you enough, Sterling, for taking the time to put this together in simple terms that the average human can understand. So thank you.
And thank you, Clayton, and appreciate all the attendees sitting in on this. Thank you.
So if you signed up, you're going to get a follow-up email with a recording of this session, and you'll be able to share it out with anybody else who you think it might be useful to, or watch it again at your leisure if there's information that we sort of blew by with the fire hose and you want to get into it a little deeper. So thank you so much, and we'll see you all at the next one.